So joining us now is Charles Hugh Smith from Of Two Minds. How are you doing today, Charles?
Great. Thank you for the invitation.
Now, I understand that you've decided to join us by having a beverage. What are you drinking today?
At the suggestion of your staff, I'm drinking beer, and it's a Kona Brewing Company Big Wave
Nice.
Ale.
I like it. It's a
It's
good island beer.
yeah, very drinkable.
Yeah, no, it's
And
actually
and
a
what
terrific beer.
Yeah.
what are you guys enjoying?
We've got the Wayne Gretzky's number 99 craft brewing company rye lager.
It's
So
a
it's
very
Wow.
Canadian beer. Very
very
Canadian beer.
Canadian.
Yeah.
So, Charles, well, it's great to have you on the show. I've read your blog for a while and always find your thoughts interesting. So, we invited you on to share some of your thoughts. So what's on your mind?
Well, thank you for the question. And I think what's been on my mind and a lot of other people's minds is negative interest rates, which, as we all know, are upwards of what, 14 trillion now globally and climbing by the day. And I think we can also toss in super low interest rates, like getting a tenth of 1% on a bond. That's so close to negative that we should throw that in too, right? So,
Right.
what does this mean? I mean, how did we get to a position where after 10 years of recovery or growth, that capital doesn't earn any return? In fact, it's paying a price to be in the safety of a bond. So my kind of thumbnail sketch of that is the system's broken. And so why is it broken? How is it broken? Well, capital in classic capitalism, and I would include socialism, frankly, capital in any system has to earn a return. And if the capital doesn't earn a return, then the system's broken. And so
Right.
that's where we've come with negative, zero interest rate policies and so on. And so now we're in a situation where capital, unable to earn a safe or low risk return, has now entered speculative asset markets, right? And so trillions and tens of trillions of dollars have poured into speculative assets. And so now houses in, desirable cities cost 1 million or 2 million. And, we see asset bubbles all in a lot of different markets. And so now central banks are trapped because we've all come to depend on bubble valuations to kind of prop up the whole system. And so we can't let those bubbles pop, but bubbles are inherently unstable. And
Right.
so you can't just keep inflating a bubble forever. And so the central banks are really trapped. And I think that should inform our investment context.
Charles, it's Kevin here. It's what I find amazing about the negative rates is the fact that we obviously have hit a point where monetarism is no longer working. You can't just keep putting rates more and more negative and expect it to work. You see it in Europe, they're falling on their face, yet they continue to talk about lowering rates to, even more asinine levels. If you didn't want money at minus 40, why do you think that minus 60 is going to be the difference? It just boggles my mind that the Germans who refuse to spend, who just like to stop and think about it for a second, if the German government goes and actually spends money, if they spent $100, they only have to return whatever it is, 99 or whatever it is. So they could actually, as long as they could spend money without doing something that where it was like loss producing, they could actually increase the net worth of their country by spending money. Like
Yeah, counterintuitive, isn't it?
Yeah, it's mind-boggling, and yet they refuse to do it. And I just wonder if it's you said that the system's broken, and I would agree with you that we've relied on the central banks for too long. But do you think that we're going to get into a point where governments are going to realize that the central banks are trapped, and it will be a fiscal response that we get? And when do you see that might happen?
Well, that's a great question. And a lot of people feel along the lines that you're describing, a lot of people feel that the governments, the treasuries, right, the fiscal side has dropped the ball, right, due to political infighting or lack of consensus or for a variety of reasons, that fiscal spending hasn't carried its share. You can argue that, but then you look at the enormous deficits that countries like Japan and the U.S. are running, and you go, well, wait a minute, how much more fiscal stimulus do you need? And so
Right.
that's the fact that we're not being very prudent in our spending, suggests that the problem might not be solvable by fiscal stimulus. Another issue that a side issue of this negative interest rates and making everybody pushing everybody into speculation is, what does it do for the standard household? In other words, the 401k, the IRA, the retirement, the decision to buy a house. All these are now basically buying chips at a casino. And so many people were wiped out in the 2008, 2009 crash in real estate and stocks, and because they gambled and they lost. And so it's like that really concerns me as a fundamental issue. Like, if it's now impossible for a regular saver to put away money and earn some sort of positive, low risk return, then that's why the system's broken. That's broken right there, because then everybody's a speculator, and then you have to have the skill set of a speculator to survive, and not very many people have that.
Yeah, and if you go look over the last couple hundred years, we've really never had negative rates. So you could argue that this is really unprecedented times, couldn't you?
It seems so to me, and then I start thinking, well, gee, then the past is not really a good guide to the future.
Right, and so
And
all of a sudden, when everyone's playing with a certain playbook, and if we can't rely on that playbook anymore, what's one to do?
Precisely. And so people are looking to inverted yield curves and a lot of other kind of technical indicators to try to get a handle on what the next 6 months is going to be, because as we all know, markets are supposed to be discounting machines 6 to 9, 12 months out. And I think the crystal ball is still cloudy. I'm not really
Do you,
sure that you can use any of that stuff.
so would you argue that the market signals that we used to rely on to determine economic policy are no longer valid?
I would say it that my confidence level is eroding in those indicators, simply because of the extremes that are currently the state of affairs in the global economy. Like, in other words, just tremendous levels of debt, and markets that are gyrating wildly based on presidential tweets, and a bunch of other stuff that's just really unusual. So yeah, I
So
don't know. Confidence in something that used to work. You can say, well, what else do we have? And I think my answer would be, well, let's just start by questioning everything and really trying to establish whether it's still working.
So Charles, so this is where I want to jump in here and really kind of I'm gonna you and Kev see eye to eye on some of these different views, but see, for me, I believe we're entering a period of sustained financial repression, where these lower interest rates are just a reality. Like, we're almost all turning Japanese, and that because no one really has a stake or an interest in the system collapsing, we're willing to accept this financial repression to kind of kick the can down the road and keep the system going. And while I think that you point out the problem with the fact that people are making very little to no return on their capital, I would, at least in my opinion, I still think that that doesn't necessarily imply that it is all going to necessarily come to an end in the short term. What's your impression, or what would you push back on that statement?
Well, I would agree with you that, and I think Kevin would too, that financial repression is the key, one of the key central bank strategies, right? And we can kind of go back to the basics of that idea, which is to keep the economy, humming along. Negative interest rates or very low interest rates will push people to spend money rather than save it, because you might as well spend it and get some return in the real world. And so, since you're not going to earn anything on savings, and so that, of course, was, I think, intended to be a short-term strategy. It wasn't supposed to last for decades, right? I mean, that's like what you do in traditional economics. You lower interest rates and kind of try to push people out of saving into spending, as a short-term boost to get out of recession. And now that's the de facto default policy. And I think the what worries me about that is you're basically reducing the pool of investable capital, which in a ideal world is invested in machinery, training, equipment, technology it boosts productivity that spreads throughout the economy and therefore boosts everyone's well-being and prosperity. And so if you've stripped the system of actual savings, then all you've got is borrowed capital, right? And so then that's a whole other dynamic. And you've also removed what I would call like financial security from the household. And so now people feel a lot more insecure. They feel more insecure in their jobs in terms of their income, and they feel more insecure about what they're going to invest if they have anything to invest.
So, Charles, someone makes you a benevolent dictator tomorrow and you can fix the system any way you want. What would you do?
God, I love that question. um, Actually, I think my answer would go along the lines of Lao Tzu and the Taoist kind of thought on what's good governance. And at least Lao Tzu of the Taoists, he often counseled that the less you govern, the better your governance, right? And so, I think that we should start by just trying to reduce this sort of arbitrary obstructions and repression that's in the financial system. And that, you can argue about what that could mean. But one possible way to start would be let's just let interest rates be set by the market. And then if that leads to financial panics, well, then and only then would the government or a central bank step in, and we can look back to like 1907 or previous panics over the centuries as a guideline. But in general, we should free people up to make their own decisions, and then we reset risk because right now everyone's looking to the central bank to have eliminated risk, and you can never eliminate risk. You only channel it into something that you have lost sight of.
So, Charles, I looked at Powell when he came in. I was firmly of the belief that he was attempting to try to reset the financial system, and he thought that the Main Street would handle higher rates quite fine. But he thought that there was a bubble brewing in the financial side of the equation, and I think that he was trying to stop that bubble before it got going too high. And then he ultimately couldn't handle the pressure. Do you kind of view his actions the same way? Like, do you think that he was intent on trying to stomp out that bubble early?
I'm open to that possibility. My perspective was more that he came in late in the game, nearly a decade into the growth cycle, and there was no normalization of rates, which is, kind of like the term we use for allowing interest rates or pushing interest rates back up to something approaching historical standards, and as a way of giving the central bank some leeway or ammunition, if you will, for the next recession, assuming that's an inevitability at some point. So he was really forced to try to raise rates as fast as he could get away with to just get something above, a quarter of a percent. And he may have hoped to normalize the entire financial sector, but I think he was probably, in my view, probably focusing on just trying to get rates up to where he had some leeway for the next financial crisis or recession.
Okay, so Charles, I asked you what you'd do if you were a dictator and you could control everything, but the reality is that almost nobody can control it, and it's actually in the fate of the market much more than we all believe. So instead of asking you what you would do if you could control the whole system, let's talk about what's going to happen. What you think most likely is how this is all going to play out, and therefore how you would position a portfolio and what you might counsel to people that are worried about the system.
Well, that's an excellent and very broad question. So I guess we can try to start by saying, well, what's the most important things, right? And so I would say one of the most important things is risk, managing risk, right? Because we're talking about a context in which predictions may not pan out and where there's a lot of unprecedented levels and extremes. And so everybody's going to be struggling to figure out what to do, right? It's not going to be some kind of obvious answer. And this is not just because of financial repression, but it's also because we're in the middle of the fourth industrial revolution. And you could count it as the third or fifth, but it's basically the digitization and automation of the economy. And so this is going to be tremendously disruptive to both labor and capital. And this is part of the reason why we see the winner take most economy that we have now, right? That the gains that have been registered have flowed to a very narrow band of the economy and not as broadly as it is in decades past. And so as investors, it's like, okay, how do we deal with the fact that we really have a high level of uncertainty going forward for maybe decades? So we're going to have to, like, number one, be much more attuned to hedging, I think, and being aware that whatever we've sort of gambled is going to pan out. If it doesn't pan out, then we're going to have to be able to cut our losses or have a hedge in place before something unravels. And so that's, I think, part of why gold and the precious metals have seen such a pop. That's why Bitcoin, despite many claims that it's worth zero and should be zero, is $10,000. Is that people are starting to realize, wow, I really need a hedge here.
Okay. Well, listen, Charles, it's been great chatting with you. Where can people find more about what they should be looking at in terms of potential hedges going forward and learning more about what you write about?
Please visit me at of2minds.com, and there's free samples of my most recent books and huge archives on any kind of financial topic you might want to seek.
Okay, and on Twitter, where can they find you?
Yeah, at CH Smith with a 1 instead of an I, so CHSM1TH.
Well, that's great. Well, thank you very much for joining us. And for those who want to hear more about Charles and his interesting background and his commuting between the mainland and Hawaii, make sure you stick around for the after hours.